and good evening. The banking sector has faced some heat this quarter as regards results and asset quality, with the exception of IndusInd Bank, which declared its Q1 results earlier this week, and we interacted with the management earlier today. The consolidated net profit for the company jumped 99% year-on-year to 1,016 crores. Net interest income for the company increased 8% year-on-year. The NIMs for the bank came in at 4.06%, lower by 22 bips. However, that was largely due to lower credit offtake, and management expects it to be in the range of 4.15 to 4.25% in the medium term. Growth in deposits stood at 26% year-on-year, with CASA to total deposits at 42%. On asset quality, in a quarter marred by lockdowns, the loan book was largely stable. Gross NPAs were 21 bips higher quarter on quarter at 2.88%, and net NPAs were 15 bips higher at 0.84%. The bank strengthened its PCR from 67% in quarter 1 FY20 to 72% in the current quarter. The bank also improved its capital adequacy ratio from 15.16 to 17.57%. We spoke with the MD and CEO of the bank, Mr. Sumant Kathpaliya, and he said that the stress for the retail vehicle loan book of the bank has been largely limited to three-wheelers and commercial vehicles, which comprise around 30% of the vehicle finance book. Otherwise, in his view, tractors and personal vehicles seem to have done well. Even microfinance has done well since it is well diversified in his view. The bank is targeting an ambitious credit growth of 16 to 18% due to a lower base and growth coming back. Management sees the main vectors of business being vehicle, finance, MFI, corporate business and SME and MSME, where they look to grow their market share from 2% to 6%. Other accelerators include the merchant acquiring business and affordable housing. As regards ROAs, the bank has clocked an ROA of 1.17% in the current quarter, up 8 bips versus March 21 and 48 bips year-on-year. The company looks to substantially improve this metric to 1.7 to 2% over the medium term. Mr. Kathpaliya believes that IndusInd Bank has left its troubles behind, with pain largely due to their extraordinary exposure to 5 corporates. The company has been a leader in the diamond and auto finance spaces, but suggested that they are looking to add new areas where they can create 11 to 12% market share to spur their ambitious growth. A large part of the problem for the bank has been its exposure to the telecom sector. On this front, Mr. Kathpaliya elaborated that the bank is comfortable with the provisions made and assured investors that there is enough operating profit to make sure that any provisions which need to be made are made immediately. Overall, Mr. Kathpaliya seemed positive that the bank had gone through a tough cycle and has emerged stronger and more resilient. A stock which stood out in a difficult quarter, definitely one to track and watch out for in coming quarters. Thank you.